There's a concept in investing called beating the market that you've probably heard of. But what is this? I mean, beating the market. Does that mean I'm literally going to the grocery store and throwing hands with everyone I see? No, of course not. That's illegal and will get you thrown in jail. Beating the market refers to having insider knowledge and getting an advantage that other investors don't have, which also will get you arrested and thrown in jail. No, of course, beating the market simply means that you're achieving a rate of return on your investments that is higher than the rate of return would achieve if you were simply only investing in the stock market by itself, typically referring to the S&P 500 or the Nasdaq or Dow Jones if you're a boomer. Now, the S&P 500 on average has returned around 10% annually to those who are invested in ETFs like SPY or VOO. If the market is making an average of 10%, then beating the market literally means that you're just getting even 1% over that. I mean, you could literally sign up for Robinhood, get your free stock deposit, and then do nothing else but invest in the market, and you theoretically, technically, would be beating the market by a few dollars. But that's not really an investment strategy and doesn't scale to the capital that you actually put into the strategy. So the question that I have is, should you really be aiming to beat the market? As in, should you be looking for a strategy that gives you an edge over the average return rate of the S&P 500? That's a silly question to ask because for most people the answer is, well, I want more money, so duh, of course I'm going to try to beat the market. The issue is that most people fail to do this. Over 90% of retail investors, day traders, and other people who like to invest are just throwing away their money because 90% of them lose the money or fail to beat the market in any meaningful capacity. The vast majority of retail investors tend to lose all of their money once they have discovered high leverage options, and because of this, the average rate of people who are successfully beating the market is below the percentage points of market beating that the people who are achieving these higher rates of returns are actually getting. So the question you need to be asking yourself is, are you really willing to risk becoming a part of the 90% of people who lose more money in the market in order to achieve a higher rate of return if the majority of average investors would be better off just investing in the S&P 500? Especially take into consideration the fact that the average person could put about $100 a month into the S&P 500 and with a long enough time frame become a millionaire, or at the very least have enough money for a comfortable retirement, similar to a pension, 401k, or IRA account. So is it really worth even getting those few extra percentages that might compound your wealth early while taking on the risk that most people will fail to actually achieve any meaningful results from doing so? It definitely is possible to make consistent returns that are higher than the market average. People invest billions of dollars and thousands of hours working inside of little office cubicles trying to figure out how they can beat the market in hedge funds. And many hedge funds fail to even make significant contributions that exceed the market's general return anyways. So you need to ask yourself, do you really think that you, 1, have the time and dedication, 2, the intelligence, and 3, the knowledge to find returns that are higher than the average market's return when people who have spent thousands of hours of their life staring at charts and reading business reports can't achieve that themselves? I would say there are lots of opportunities for retail investors. It's very easy to get lucky, and it's also very easy to get burnt. The real thing that you need to consider for yourself is whether or not you're willing to take the time to spend a significant portion of your life studying the stock market, managing your money, and spending countless hours crying over your Robinhood portfolio because your definition of risk management is buying 1 DTE options instead of 0 DTE options, and now your calls are down 55%. So what I'm trying to say is, it's not necessarily not worth your time to study the market and learn how to trade stocks and options and look for good companies or ETFs to invest in. Rather, what I'm saying is for the average person, for literally 90% or more of people who cannot by themselves return a higher rate than simply investing in an ETF that tracks the entire market's movements, it is better for them to just settle for that rate of return. By no means is 10% on average annually a bad rate of return. That's enough, again, for most people to reach a comfortable retirement age, assuming they have a few decades to invest it. If you're closer towards your 60s, sure, by all means, go YOLO your life savings on whatever stock is trending the highest on Wall Street bets at the moment. If you absolutely need to be a billionaire by tomorrow because you didn't have any time frame horizon investing before now, but that's not really sustainable or good advice. Actually, that's probably the worst advice you could probably receive. This is not financial advice. Don't YOLO your money, especially not on a ticker you just found on Wall Street bets. Here's another way to think about it. Time is money. The reason that people want to invest primarily is so that they have enough money that they can live off of their investments or not be concerned about finances, so that they have more time to do the things that they want to do. In order to achieve a rate of return on your investments that's higher than the stock market's average return, you need to spend a very, very significant portion of your time researching how to achieve that, or you need to get very, very lucky. Therefore, you need to ask yourself if the average person is able to achieve a healthy financial status from just investing in the stock market without any fancy shenanigans. Are you willing to sacrifice that time now to research that in exchange for time later? Or would you rather have that time free to do the things that you want or need to do now, knowing that it's guaranteed later because the average rate of return is sufficient to achieve that same status that you seek? A big portion of this argument can also be brought down to risk tolerance. If you're trying to beat the market, you're inherently going to have to choose strategies which are riskier than achieving the average rate of return. I would argue that it's almost impossible to find something that is not risky that would give you a greater return rate, because if there were such a thing, hedge funds would already be doing it, and then you could just invest in those. Because no such a thing exists, if you wish to make more money than the average return, you are going to have to take on more risk. More risk leads to more opportunities for failure and gets you closer to being in that 90% that doesn't make significant returns that are greater than what you could do by literally doing nothing, but throwing your money into SPY over the next 20 years. I'm not saying that you shouldn't ever consider trying to do your own personal investments, or that you may not hit something here and there that is significant, but do understand that it takes a very long time to learn and develop a system that gives you a significant and meaningful edge over what the average movement of the stock market is. And in doing so, you're going to have to sacrifice a lot in order to learn and develop those systems. Whether that be just learning how to trade stocks, trade options, or if you're learning some other method of hedging your finances, it's going to be far more active than passive, and as such is going to require much more of your time. I encourage you to reflect on the reason why you're interested in beating the stock market. Is it because you need a lot of money? Is it because you want to retire earlier? Is 10% not enough for you? These are all very valid things to consider when making your choice. But another thing that you could consider is having somebody who's already dedicated their professional life to studying the stock market and managing investments. I don't necessarily think that a financial advisor or investment manager is the right choice for everyone, but it's another thing that you could consider if you truly think that it's possible for somebody to beat the market, and you also don't want to sacrifice a considerable portion of your time into figuring out how you're going to manage to achieve those higher returns. So to summarize, if you're interested in investing in the stock market, for the most part, it's a better idea for most people to just purchase ETFs or index funds that the market as a whole because the rate of return that they are going to achieve is greater than the average investor's choices, which tend to underperform again over 90% of the time. I know a lot of the things I've said now are very repetitive, but I really want to drive the point home. Most people, the vast majority, are not equipped enough, lucky enough, or skillful enough to make significant investments that are going to leave them better off than if they had just invested passively. I think it's something that you should truly consider and ask yourself, why are you any different than the average person? What sort of an edge could you have that would let you make those returns, and is it worth your time and within your desire for risk to make that gamble when you're far more likely to do better by just choosing not to do it at all? And if you are consistently and significantly beating the market, hit me up. I'd love to have you do it for me, and I'd be willing to pay you, as I'm sure thousands of others would. Thanks for listening to my thoughts on this matter. I'd love to hear what you think and what you have to say, and your reasonings why you're better than 90% of people and how you are going to single-handedly beat everyone else at this game. Now, if you need me, I'm going to be crying in my bedroom while I look at all of the red numbers on my options chains from suggestions I got from stocks from users on Wall Street Bets.